Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen, and today we are live again here this week, Monday, same time, same place. If you are living in Europe, where the summertime changed back to standard or normal time, it's always a nightmare. I hope they will just kill this summertime, standard time change. Anyhow, thanks for joining me today. What are we doing today? We will review some main markets. In the last 2 weeks, I showed you some nice new features. I hope you like the idea of volume cycles. I hope you followed the idea 2 weeks ago about the longer term volatility cycles. Today, let's get back to the daily cycles on main markets. That's the topic for today. As I'm live today, feel free dropping in your questions. I see the first rushing in. I will get back to your questions latest at the end, and I will monitor it. Maybe I will get back to it while we are talking here. So let's start with a main update of daily market cycles here. So therefore, let's switch to our cycle analyzer and quickly go through the key markets here. So let's start with the main markets as the S&P 500. I mean, this uptrending market is a nightmare for cycle analysis, at least on the daily cycles, or at least if you review the last let's say 2 years, or 1 to 2 years. Why this is a nightmare for daily cycle analysis? Because if you use this time frame, you just see this straight up move here. If you just take the last 2 years into account for detecting shorter term cycles, which will not help us anyhow because we just see an uptrend. So in this case, if we use daily analysis, or if we want to use daily analysis, we must choose a very longer period that we have cyclic behavior in our data set. Otherwise, we will not detect cycles, or we will detect nonsense, which will not guide us in this clear uptrend, which was, to be honest, a real challenge using cycles on the main global markets like the S&P 500. For me, for the last year, at least daily cycles, have not worked on the S&P. I mean, they have worked on the intraday level, but there you need more experience to do this. So therefore, anyhow, but it's a market, so let's check it here. So first recommendation, we need to load more data here, as just using this simple upturn here seems not to be enough. So let's add some years of data here to the chart. So now we go back to 2010. Let's update the cycle analysis. So now we use a set of 10 years of daily data here in this case, so we can see how this looks like on the chart here. So we have more data than just the last 2 years. And then let's have a view at the cycle scanner here, which also includes that we see much more cycles in the spectrum, which makes it even harder to decide which ones to pick, by the way. But let's use the standard procedure, as we will do always. So the one which stands out here is more or less a yearly cycle with 364 days. Let's choose this cycle here to add this onto our chart here, which has been done now. Yeah, I mean, it's hard in this uptrend series. So now let's add some more cycles here which could fit into this data set, which could be the 271 and the 166. So the 166 stands out here. And the one, what I said, 271. Where is it? Here it is. It has a good Bartle score, even though the strength is a little bit lower, but it's a long length and a high Bartle score. So I will add these 3 cycles to the mix here. You see from our statistical score, we choose a series of 10 years of data, which gave us a green score on the correlation. It means a green score, we are above 0.5, which at least tells us we have a positive correlation of the cycles and price. Which is more or less obvious because we choose the 3 key cycles here. And we see, and this is what I want to tell, since November last year, so this period, these cycles have gone out of sync. So this is, and I don't have a real update for you. So at this point in time here, somewhere here, let's say here, so there's November. Yeah, they work nicely, and then they projected here this uptrend here, down here, and another uptrend here, but they have not been able to guide us on the daily series. So you need to switch to the weekly series, which I did 2 weeks ago. So I will not repeat this procedure, just switch back 2 weeks ago on the weekly S&P update. Daily cycles, we don't get a clue, or they are not in sync with the current market behavior. So there might be other forces which are more dominant than cycles right now. Okay, so that's the reading on the daily series. Longer term, weekly, shorter time, that's a different message. But if we stick to the daily analysis, that's the result for the S&P 500. And I think it's also important here on the channel to be aware that there are periods in time when cycles will not help you, giving you a clue on something. So this is always something you need to recognize. And I mean, we are here for cycle analysis, so we don't want to squeeze out a cycle projection just because we want to have a projection. You need to acknowledge this fact. So then let's switch to other current data sets. For example, if we see that in the raw main data on the S&P daily, we don't get results which are in tune with the markets, maybe we should choose other data sets. Like what I often repeat here is sentiment data, like financial sentiment index, financial stress index, which is a weekly measure also from the Federal Reserve Bank, or the volatility index, so-called VIX index, which is also a kind of measurement of fear, not directly, but indirectly. It's also related to the stress level of these financial markets. So now let's have a look at the cycles in these 2 asset classes here. Let's start with the weekly financial stress index here, which is updated once a week. So here we are on a higher time frame. What is very important on this measurement here, that we have more or less an historical low, yeah, of the financial stress index. If you go back in time, I mean, when did we have this low measurements? Maybe at the market top in 2006, 2007. So just from the absolute levels, we are in an extreme bullish sentiment. So there's so much trust in these financial markets and in the asset classes here, which have never been seen before. Which is always the risky point. So when you reach these extremes, just from the absolute value, you have to be on alert. At least the markets are at high risk here, but nothing to do with cycles. So now let's add the cycle analysis here to this mix. Maybe we should also could add a little bit longer period here for the analysis. So I will update our analysis here so that we use this period. Let's look at the spectrum, the 190. Could we want to go here? Yeah, and you see this is also a good alignment with the behavior. I mean, you can't time it exactly to the week. Yeah, if you follow here the real peaks and lows in the financial stress index, you see, I mean, they are quite good aligned here. The top here is then more to the right. But the important point to make, and this is the same picture which we have seen from the weekly S&P analysis, is that you see where we are, yeah, in this procedure here. So, I mean, we can't trust it to the week, but the absolute value is at an extreme low, and the dominant cycle of this financial stress index suggests that we have a stress cyclic low, which is in alignment with market tops. Yeah, so at least the daily S&P cycles don't give us a clue here. The weekly did, and the weekly financial stress index speaks a clear message. So the weekly cycles are in alignment on the global markets. So let's add now the volatility index to see what the volatility index might show us here for a picture. I will add, let's start with 2017 here, so that we have 1, 2, 3 peaks from cyclic behavior here in the mix. Here we have a clear daily cycle in the volatility index, which shows up with a length of 175 days. Let's select this cycle here, which is now overlaid here. Yeah, and I mean, just from the last 3 cycles, it seems it's also out of sync. Yeah, you see the same picture in the daily volatility index of the S&P 500 as we did in the daily market data, which means same picture since November, November 2020, which is here. I will show it here. I mean, the low was spot on, but then starting in November, somewhere here, from this point in time onwards, also the volatility cycle has been out of sync. And you see this from the correlation score here on the right hand side, even though that the overall beat of this cycle here was quite nice. And you see, if I zoom in, I get a green correlation score. If I zoom in a little bit more into the past and skip just the last 1 year. So if you go more into the past, there was a great fit of this dominant cycle here in the volatility data. But as I said, even until even until this point here, then it gets out of sync. So the volatility index daily, same message here. We can't trust the daily cycles. We just need to rely on the weekly cycles, and then we can go to lower intraday timeframes. But I will not go to the intraday level in this session here. Gruesh, I think you had a questions about the time period for the wave. Please give me a hint. I've not followed when your question showed up. So give me a hint what I showed, and then I will try back. And Joan, also to get back to your questions about the volatility index, as this is a volatility index here, what we see for the S&P 500. So yes, I would recommend to use the volatility index on different asset classes. I mean, the VIX index is just for the S&P 500. So yes, we should also use the volatility index on the crypto markets. I'm not in the details here of different volatility indices on the crypto markets, so please drop me a quick info on which volatility data you're thinking about, talking about the crypto, and then I will bring this in the session here latest by next week to also show the volatility index information or cyclic index information in crypto. It works very well because you can read it as a kind of sentiment data, which I showed here in the S&P. However, just for the S&P, so the US global markets, we cannot rely on daily data. But this does not mean that volatility cycles don't work. It's just the current situation here, right? Different asset classes now, as you mentioned, anyhow, the crypto. I think the crypto, if you follow this channels here, we had a nice run and a nice call on the cryptos here. So this is the current behavior on Bitcoin. We just made a new high 1 or 2 weeks ago. We crossed above the 60K level again with a major high. And I think you know that we talked about the main cycle, the nominal cycle of 200 days, which I just selected here. So this is, and it morphed now into a longer term cycle here, which seems to get the 290 days. The 200 day cycle is here. So you see that the peak is the peak of the older 200-day cycle, which was valid in the past, and I did a lot of analysis on that in past videos. It is now wrapped by the longer-term cycle. Yeah, you see that the peak disappears now in the spectrum. So, and this is what I always would recommend. You should have a clue about how the spectrum evolved over time in this asset class. Because if you just would look at the cycles in crypto today, you won't see the 200-day cycle anyhow. But if you are aware from the historical point of view, the peak was there for a very long and very important time. However, it's now wrapped by the more larger cycle of 290 days. So it looks like we have a shift in lengths. Yeah. So this is what I often try to explain with dynamic cycles. The length is not stable, and the nominal cycle around 200 days has morphed into a more longer cycle, which is more above the 250 days, maybe 290 days. So we see where this cycle moves into. We can also use the harmonics here to get a clue. But at least it suggests that maybe the upswing might continue into December. So this is not the final top here. If we go back a little bit in past, you know that we projected the bottom here in June, right on time, live in this session here. Just going back a little bit in time, you still see that the 200-day cycle, we need to add a little bit more historical data. This is not enough. So I just use, this historical information is not enough to give a real clue on the data. So there I will add some more information to recover the 200-day cycle here. So we have this 1, 2, 3 peaks here in the data, that we have some more cyclic information in this data set. And here you see that the nominal 200-day cycle gets visible again. So it's always the question of how much historical data you put into the cycle analysis, which will then result in different outcomes. So maybe if you're new to cycle analysis, you always need to make a decision the length of the historical data you throw into the engine. This makes a difference on the outcome, and at least the recommendation is, the basic recommendation is you should have at least 3 times of the longest cycle you want to detect. So for example, if we talk about the nominal cycle of 200 something, so let's say 250 at maximum, multiply it by 3, you get to 750, 800, which is a minimum you should have. And then you should also have a look at the data set. If these 700 data points are just a straight line up or just have one peak, no cycle algorithm can really detect different cycles in just a linear trend or with just one fluctuation. So you need to ensure that you have 1 or 2 real peaks or lows in the data set for the cycle scanner here as a general rule of thumb. Otherwise, you will not get reliable data from the cycle scanner. But this is just a repetition what I just want to teach or bring across here on the channel. This has been the 200-day cycle as we have followed this cycle from June, and what I want to say is where we now have arrived at the top prediction based on timing, what we did since summer here. So since June, this 200-day cycle predicted a top around October, November for this data set, which arrived perfectly as projected. So that's also the point of learning maybe for today, that there are asset classes where cycle analysis works. So for the last 6 months, the Bitcoin cycles worked perfectly. And I showed you upfront why we could expect the cycle to work. Please go back to the June summit where I explained the longer term analysis. And on the other side, we currently see the S&P 500, where we can conclude that the daily cycles are not reliable right now. But I also repeat that they are not reliable. So in both markets, the cycle scanner will throw out cycles from the analysis point of view, but we should have knowledge, which I try also to bring into the mix here on this channel, which gives us either confirmation that we can follow this cycle, like in Bitcoin, and please review, there's a long-term analysis why we could trust Bitcoin. And I repeated for the last weeks that the cycles in the daily cycles in the US global markets are out of sync. So even though we see the cycles, we cannot trust them here. And if we see this situation, we need to move to a longer term period, like we did with the weekly cycles, which looks good, or lower periods like intraday. But if you are not in intraday trading, you should not move to intraday cycles. Okay, so there's the update for Bitcoin. This is just, I wanted to repeat the historical analysis. If we bring in now, all data into the mix here and update the analysis, you see now the key cycle seems to become the 290 something length here. So which could give us a kind of indication we should be on alert that maybe we achieve the top right now, but it could prolong into the December period when both cycles, the 200 nominal cycle and the more or less 300 nominal cycle, seems to get into alignment on the top projection here. Yeah, so, and if we add both cycles, so we still see here's the nominal cycle with a length of 200 something, so 230, combined with the 290. This is end November, beginning of December. So we are right on track here on this projection, and the timing window is end November, beginning December. That's the cryptos. So just getting back to your questions, Johan, Lars, if you are in an asset that does not even have in day periods more than 250 since creation, do you then trust smaller cycles, say an incl that has less? That's the general rule. So if you have more than 3 times of data points than the cycles you want to analyze. So for example, let's use your example where you just have 250 data points since creation. Divided by 3. And if you divide it by 3, I think you get to a length of 70, 65, 70. No, 80, maybe 80, 85. So the longest cycle you can look for in a data set with just 250 data points is a length of 80 bars or days. Depends on the time frame you're using here. So you should be aware of that. The cycle scanner might show you longer term cycles, but you should not use any cycle longer than 80 if you just have an input of 250 data points. And you could detect shorter term cycles anyhow. So there could be a 20 days or 40 days cycle in this data set, which you could detect if you just use the 250. But as said, you should have a minimum of a multiply of 3 of the longest cycle you want to detect in minimum. So if you want to detect a cycle with a length of 100, you should have at least a minimum of 300 data points. So, and your question, you can trust shorter cycles, and so you can use the 20-day cycle if detected in a 250 period. So that works. You just need you have a kind of threshold when you should stop trusting a cycle in this data set. That's my point, Johan. I hope that it explains a little bit or answers your questions on the cycle lengths. Okay, so yes, you can trust smaller cycles. That's the very shortest answer I can give here. But feel free to drop in any questions. That's the purpose of the live session. Yeah, we did the main markets. I explained a little bit in which asset it works, in which asset it does not work. So let's also switch to the commodities like gold and silver. Let's see what gold and silver cycles do show up. We are more or less hovering around in a sideways move somewhere here. So let's see what the scanner or the spectrum shows us. I would again add a little bit more data, as this looks like it's more or less an trending where we don't have enough cyclic movement in here, even if we would detrend that. So therefore, standard procedure would be add more data to the analysis first. Therefore, I often use to switch the visual here. So the light blue is the out of sample. So the light blue is not used for the analysis. It's just the dark blue. So if we want to throw in more data, let's go back to 2011. So we have some more peaks here. I use the anchoring function here of our cycle scanner. So I switch with the arrow here, the anchoring somewhere here at this point. So, and then I update the analysis. And now you see the full period switches to dark blue, which means all these 2,600 bars are now used for the analysis. Let's look at the spectrum here. So now we get 3 clear peaks in the spectrum. This is what I'm looking for, so that at least we have a good input data set from the lengths, from the cyclic behavior here, the minimum offset. Then let's get into the spectrum. So we have the peak of 125. 279, 323 here, so which we should use for our analysis. So I will activate these cycles here in our composite cycle model. And then let's look. You see again here, picking these 3 cycles over the period of 10 years has a positive correlation between price and cyclic turning points. That's what we're looking for. At least if it switches to green, I would not put too much attention on the exact mathematical level, the correlation score. It just needs to be above 0.5, so it has a positive correlation. In the overall past, 10 years anyhow, a long time frame, but we have 3 cycles with a positive correlation of 10 years of history. I mean, you see this here also in the data. And then we should look at the current outlook. And I think we pointed that out, so that the top here was projected anyhow for a long time. So this was a stable projection here at this point in time. And I think then we projected this bottoming area here with a more or less upturn here, which then did not play out in full. So this was the original projection here we showed on this channel. So this is now how the cycles a little bit have changed. So the updated analysis is that we, let's zoom in a little bit, so that we are, this is the reading of this cycle here. So I think this low has arrived here. So then this uptrend is this upswing here, so which is a little bit shifted to the right. That's okay for cycles, as even we have a shifting in phases, and it looks like that, and I will switch the color here for that, so that this sideways move here, no, it has not changed. This sideways move here on the cycles looks like it's a little bit left shifted, as here is now this sideways move here, what we can observe in the metadata. So interesting for gold is this point in time here. So this is what we're looking for. If we do cycle analysis, we are looking for the next important point in regards to time, which comes into play at the end of this year. So maybe we see now, final conclusion, maybe we see now a sideways move in gold until the end of the year, where the cycles then project another important top, and maybe with a down projection into the first quarter of 2022. That's how we read the cycle analysis, and let's update at the end of the year if we can confirm the sideways move. If yes, it looks like the cycles are valid, and then see at the end of the year if we will at least see a top there and continuing downwards move in gold. And we should update the same analysis in silver here. But I would then recommend that you update the same analysis in silver to confirm the idea. Never trust one single cycle or one composite cycle in just one asset class. You should use confirming asset classes or data sets to give you more validation or confirmation that the cycles look relevant. Okay, yeah, that's it for today. It was a quick update. We are running for 30 minutes. I would stick to the 30 minutes time length we decided for. So if you just have additional questions, feel free to drop them in the section here. I will just monitor if there's anything you want to know in addition. And yeah, next week, Monday, we will continue here. I will see if I can find another special topic here besides the standard update for daily analysis on cycles. I hope you like the quick update on the main markets, crypto and commodities, and a little bit of explanation and learning why choosing this or that length. Right, so thanks for joining me today. I would like to see you next week and have a good week. Bye.